Yeah, I'm incredibly humble to comment on this because I would like to add so far. So what is the biggest impact so far? We have seen the last couple of months, of course, it had tremendous impact, but we are far from seeing the end of it. And we have seen the largest GDP decline in my lifetime, actually, and basically almost 10% decline in Europe and 8% decline overall according to IMF forecast and almost 5% worldwide. So it has a tremendous impact, and even IMF is reassessing its projections all the time. And we don't know how the COVID situation will evolve, and we have a lot of moving factors. So we have a lot of uncertainty, and further, we also have an unprecedented intervention from the government. To some extent, 40% in certain countries, what they put in different grants, support systems, subsidies, so on and so on, in the economy. So we are all assessing what does it mean for the global economy and what does it mean for our underlying portfolio companies. So the biggest impact is basically assessing the situation for portfolio companies, being very humble, seeing the different aspects, how this pandemic will pan out. I think that this humbleness and this uncertainty is one of the aspects. The second is, of course, trying to help borrowers, So I think we had a general consensus is that these are unprecedented times, and let's do unprecedented efforts to see through the crisis and make sure that we have a long-term approach to maximize value for all stakeholders. So I saw a softer approach from everybody, actually, a more helping attitude from everybody. And of course, what is also going on, a very huge impact assessment. What does it mean for us? What does it mean for capital charges? What does it mean for return? What does it mean for performance? So we have to assess from many different angles. And on the positive side, I also see increasing demand from borrowers because banks are withdrawing from the market further. And it also means that a lot of deal opportunities for GPs to come. Initially, a lot of GPs were assessing liquidity needs of companies. So I think the focus was on liquidity, also from the banks, and they try to see from the borrower side, how can we actually provide us excess liquidity because we don't know what is coming. So I saw that first tendency of being extra cautious and have extra liquidity buffers. And this is applicable in the bank, this is applicable for LPs and also for GPs underlying portfolio companies. So that sort of approach was very present, and now it's really trying to assess longer-term portfolio impact and categorize different companies. Of course, this 8% decline in Europe is 8% on average, but there are certain sectors that are heavily hit. Tourism, everything related to retail, and some sectors actually had a turnover decline of 70–80%. So what does it mean and how can we sort this out to maximize value? So I see an intense communication between borrowers and lenders in every segment, whether it's alternative lending, digital lending, private debt, and banks. So very intense communication to try to see what the impact will be. And I think there is a general consensus that it's still yet to be seen what it means to us. I think we got a break. Many people, also consumers, borrowers, got a break. And I think people see, okay, now, but what will come in Q4 and Q1 2021? Yeah, I think there is a massive shift, basically from focusing new deals to portfolio issues. especially for banks. And I saw a very big shift in number of leading banks moving front office people to basically middle office and helping about portfolio company restructuring. So I think it's very present. So intense focus with the borrowers. Almost all companies are impacted, let's be honest, there is massive requirements for resources. So that intensity is clearly there, and the communication has changed, of course, because due diligence cannot be done in the way we used to, communication cannot be face-to-face. It impacts work intensity, modus operandi, risk profile of GPs, risk profile of banks. So a lot of focus had to be spent on ensuring security of remote working. You know, just simple things, how you get signatures, how you communicate in a safe way, how you make sure that the systems are secure. So all these things had to be arranged. And it took time and management focus. So right now is a lot more on portfolio impact, what it means for capital, what it means for lending capacity. And I think banks are very much focused on existing portfolio issues, which creates a lot of opportunities for private debt and alternative lending providers that are less impacted and have a lot of dry powder. I have always been very positive on private debt and the future of private debt for a number of reasons, and of course there are a number of caveats as well. Maybe I will start with the caveats. You know, this industry went through a tremendous shift in the last 10-15 years with a lot of complexity. And complexities in terms of business models, complexities in terms of regulatory aspects, sizes, focus on borrowers. So this complexity was huge. And I think what we will see is there will be winners and losers. Like in every crisis, there will be winners and losers. And those who had been managing portfolios and managing risk very well, and I'm not only talking about for underlying portfolio companies, but their own organization, they will prevail winners, and some will need to step back. Whether it would mean selling the business or giving back the license in case of an asset management company or potentially a bank, and that they can't cope with regulatory charges or the losses they have. We don't know it yet, but there will be clearly some sort of consolidation in March of the sector. So that we will clearly see. And I think the disintermediation will further continue. So why do I say that? I'm very confident that LPs, both from the institutional side and also from retail side, they will search for yield. One of the most important aspects of private debt is the coupon. You can't find it in private equity, and you certainly cannot find it in public market. So I think we will see a huge interest going forward for private debt products and also alternative lending products, which was actually also confirmed by a number of surveys I have seen recently by leading players like Nurse Finance and so on and so on. So all surveys confirm this further shift towards private market. So I'm very positive from the demand side as well. Further, I think the best opportunities are always seen after the crisis in terms of risk-adjusted return. We have seen it in 2008, 2009. So we will see shift in risk profile, so a lot more lender-friendly environment and better risk-adjusted return in private market. And maybe two other trends I would like to mention. Why am I positive about private debt is the huge universe for ESG opportunities in private market. So LP communities focusing a lot more on ESG opportunities. In SME lending, you find such rich opportunities to make an impact. So this will not come from public market. This will also come from private market. And I do feel that this whole environment will facilitate further digital transformation. So companies that have a good solution for digital underwriting, digital due diligence, digital risk assessment, they will gain further strength in the ecosystem. So overall, because of these reasons, I'm very positive about the future of private.